Hello, I'm Tony Kay. Welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, good. This week you're in Sydney, I'm in Melbourne. So anyway, we're going to manage it on our cross-studio link. Evan, let's talk about business confidence, consumer confidence. What are you seeing there?
Yes, this week was always going to be interesting from last week. So as we spoke about on Wednesday last week around the economic review of retail sales, expectations from the consumer side and how that was feeding into the retro data. The retrospective data has been backed up by the forward-looking data already. It was interesting, the business confidence numbers that we got out actually popped up, which I found slightly interesting considering the previous month, the reason for the decline was government intervention. That's clearly around what's going on in gas at the moment, but also the North Korean tensions. To jump up 2 points in confidence was slightly unexpected. Even NAB sort of noted that as being slightly unexpected. It's still optimistic, but they do highlight very clearly that the part of their survey that is under real pressure is retail. And that gets into the next side of this, which is when we do get the Westpac numbers, it is clearly going to show that it'll be the 11th consecutive month in pessimism, and it will be the main reasons that they have been for the last 10 months previous to that. But what you need to highlight is how much of an influence interest rates are becoming for both business and for also the consumer. And the gap between consumer pessimism and business optimism is actually now growing at a rate that is also probably becoming slightly scary. And the reason for that is that part of the optimism from businesses, profits are growing, that you're also seeing business conditions flowing through to sales, through to cash flow, through to revenue, etc. But what it's also saying is that isn't translating into wage growth, that's translating into probably just balance sheet sort of fixation or looking at basically sort of knuckling down and fixing up the issues that have been the last 2 to 3 years and not translating into employees. So all of that's there, and that feeds back into this whole mantra that we've been talking about for a while, which is where does the RBA go in 2018? And this is a really good forward-looking indicator, these two surveys. And it clearly shows that the consumer is probably the biggest concern for the RBA, and that's likely to continue for a while.
This raises the whole issue around businesses reinvesting into their businesses, whereas a lot of businesses are using their increased cash flows to repay debt. So, and that translates, of course, back down to the employees in terms of wages, etc., and consumer confidence. So, we're not seeing, but there's obviously that rise in business confidence, but it's not flowing through because businesses aren't necessarily reinvesting in their businesses.
Yeah, and that's exactly what it's showing is if you look at the data that we've also seen from the ABS and around wage growth, it's not flowing through. We know that employment's picking up, and that gets back to your point that you just sort of alluded to, Tony, which is that business reinvestment is there, and part of business reinvestment is to clearly increase your staffing size, add additional services and manufacturing goods onto your actual list. But it's not manifesting in wage growth. And that therefore comes down to, again, the biggest concern facing the Australian economy at the moment. If you look at GDP and you look at the equation, consumption equates to around about 45% of GDP. And if you aren't getting consumption happening at a reasonable rate, that the expectation of reaching 3% by the end of next year by the RBA is clearly out of the water. And what happened in July and August, it's not normally something I highlight really quite strongly with retail sales, but that was it's such a sharp drop that it does clearly show you that there is pressure. And if the economy was to see an increase or even just a slight tightening in interest rates, that the tightening of the belt from the retail consumer is clearly going to happen. It filters through to the household debt level and it filters through into household affordability. So all of that is why it's so delicately poised, and you can see that discretionary on the equity side is almost a beacon at the moment for what's going on in that space, and they're all screaming out and telling the same things, that things are tough. And that's interesting because it's normally this period that you actually see quite a reasonable time with leading into that Christmas boom period.
Let's just have a quick look at what's going on overseas and how that may impact us. So we were talking off camera about China, some data out of China.
Yeah, look, the Chinese data is actually going to become more and more important from my perspective anyway for the market. And the reason I highlight that is that this is one of only 2 national congresses that happen every decade. It's a ginormous piece of data. And this week you saw the PMIs out of China being strong on the state side and weak on the private side. And there's growing belief that the Chinese are going to really start trying to, basically almost restate everything and move away from the private enterprise that's been injecting capital into the market. Their concern is that private capital has been flowing offshore. Now, the Australian-centric point of view of this is short-term, the demand for iron ore and bulk commodities will be there, but on a medium to longer-term view, it's probably going to filter out. Now, there's also talk that you've already seen in the last 2 weeks a fairly reasonable dry up in actual capital flows towards building products and also towards bulk commodities. There's a lot of talk out of particularly Xinhua that this is happening. And again, we've had a really good period in this country with better than expected commodity prices, better than expected growth in cyclical plays. Are we going to see, leading into this People's Nationalist Congress, a slowdown? And therefore, does that translate into the back end of the year and then the start of next year with regards to equity movements? Probably. It also means there's an impact on GDP as well. Net exports are the reason we're doing quite nicely, and that is because prices have been better and volumes have been better on exports. If they do slow down, like we're starting to sort of see, that's another impactor as well.
All right, Evan. Well, we'll keep a close eye on what's going on over there as well. Thanks for joining us again on the Economic View.